The ultimate guide to dividends and dividend investing. Collecting profits for the rest of your life and creating an automated revenue system is something anyone would want. If this sounds like the kind of financial planning strategy that appeals to you, you might need to learn about dividends and dividend investing. And therefore, in this video, we bring you the ultimate guide to dividends and dividend investing. This video has the potential to change your future. So make sure you watch till the end and learn all that you need to know about earning from dividends. What is a dividend? In simple terms, a dividend can be called a distribution of profits by a corporation to its shareholders. Whenever a corporation earns a profit or surplus, it can pay a proportion of the profit as a dividend to its shareholders. Any amount not distributed is taken to be reinvested in the business. Dividend investing is based upon building an assortment of the alleged safe blue-chip stocks and regular profits that generate money consistently. Dividend investors have the joy of seeing regular cash deposits show up in their brokerage account. We'll tell you about the characteristics that many dividend investors consider essential for selecting good dividend stocks for your investment portfolio. There could be issues with the underlying business, or the dividend payout proportion might be excessively high, which compromises the future development of the company. The company might have a debt-to-equity ratio that causes investors to accept that the organization can't survive in the long run. You need to consider many factors before choosing the right dividend stock. Why not all stocks pay dividend? With research proposing that dividend stocks generally outperform non-dividend stocks, then why don't organizations deliver cash profits on their shares? There might be varied reasons as to why a company's board of directors might choose to hold off on dividends and instead choose to reinvest in the business, pay off debts, or acquire another company. But if a stock doesn't pay dividends, how can it be worth anything? This is a common question posed by new investors in the market. The answer to this is simple. If the board makes good decisions for the company, then despite it not delivering cash dividends, the company can still make its owners millionaires. Is dividend investing a good strategy? Dividend investing can be an incredible investment strategy. Dividend stocks have generally outperformed the S&P 500 with less volatility. That is on the grounds that dividend stocks provide two sources of return: regular income from dividend payments and capital appreciation of the stock cost. This total return can accumulate over time. As a result of their lower volatility, dividend stocks frequently appeal to investors searching for lower risk investments, particularly those approaching retirement. But dividend investing can also be a great source of investment for young investors. However, it's also to be noted that dividend investing can also be risky if you don't know what to avoid. Consider purchasing 100 shares of an organization for $10 each, and each share pays a dividend of 30 cents every year. If you invest $1,000 over the course of a year, you would get $30 in dividend payment. That gives you around 3% profit, which isn't too bad. Now, what you decide to do with your profits ultimately depends on you. There are a whole lot of options for you. You could reinvest them to purchase more stocks of the same company or buy stock in a different company. You can also choose to save money or spend it on different assets. Whether or not the organization's stock price goes up or down, you'll continue to get those dividend payments as long as the organization keeps on dispensing them. The whole beauty of stocks that deliver dividends is that a part of your return includes predictable quarterly installments. Not every company offering dividend stocks can maintain a profit payout in all financial climates, which is proven by the COVID-19 pandemic. Yet, if you have a diversified portfolio of dividend stocks, you can generate reliable income consistently, consolidate those dividends with capital appreciation as the companies you own, and the total returns can match or even surpass those of the more extensive market. The factors to consider before investing. Before you purchase any dividend stocks, it's important to evaluate them. These evaluations can assist you with understanding how much in dividends to expect, how dependable a dividend stock might be, and above all, how to identify the red flags. We'll tell you about the major factors you need to look out for before investing. Dividend yield. This is the annualized dividend as a percentage of the stock price. If a company delivers $1 in annualized dividends and the stock costs $20 per share, then the dividend yield would be 5%. Yield is helpful as a valuation metric when you contrast a stock's ongoing yield with its previous levels. A higher profit yield is always better. However, an organization's capacity to keep up with the dividend payout, and ideally even an increment, also matters to a large extent. However, a strangely high profit yield could be a red flag. Dividend payout ratio. This is the dividend as a percentage of a company's income. If an organization earns $1 per share in a total income and delivers a 50-cent per share profit, then the payout proportion is 50%. Generally, the lower payout proportion, the more sustainable a dividend should be. Total return. This is the expansion in stock prices, also known as capital gains, in addition to the profits paid. If you pay $10 for a stock that increases in value by $1 and delivers a 50 cents profit, then the $1.50 you gained is equivalent to a 15% total return. Earnings per share, EPS. The EPS metric standardizes an organization's income to the per share value. The best dividend stocks are companies that have shown the capacity to routinely increase income per share after some time, thus increasing their dividend. P/E ratio. The price-to-earning ratio is determined by dividing a company's share price by its income per share. The P/E proportion is a metric that can be utilized alongside a dividend yield to decide whether a dividend stock is generally valued. While these factors are important enough for choosing a good dividend stock, you always need to remember that high return isn't all that matters. New dividend investors on the block frequently purchase stocks with the highest dividend yields. While high return stocks aren't awful, high yields can be the consequence of a stock prices falling due to the risk of the dividend being cut. This is known as the dividend yield trap, and any investor should be aware of it. How to not fall for the dividend yield trap. Try not to purchase stocks dependent exclusively on the dividend yield. If an organization has fundamentally better return than its peers, that might be a sign of trouble and not opportunity. You need to use the payout ratios to check sustainability of the dividend. Check the organization's dividend history, both payout growth and yield. Study the balance sheet, including debts, cash, and other assets and liabilities. Consider the company and the industry itself. Know if the organization's business is at risk from factors such as strong competitors, falling demand, or other disruptions. Unfortunately, a yield that looks too unrealistic might as well be. Therefore, it's always smarter to purchase a dividend stock with a lower yield that is sustainable than to go for a high return providing dividend that might prove unsustainable in the long run. Besides, focusing on dividend development, a company's history and capacity to raise its stock dividend often proves to be more beneficial. Should beginners invest in dividends? There's a misconception that dividend stocks are just for retired people or those investors who try to avoid risk. That's not true. You can consider purchasing dividend-paying stocks whenever you begin investing to reap the long-term benefits. Dividend stocks, particularly those companies that reliably increase their dividends, have generally beaten the market with less volatility. Therefore, dividend stocks are ideal for any portfolio as they can assist you with building a diverse portfolio. Another major aspect of dividend investment strategy is to invest in mutual funds or ETFs. These options enable investors to own diversified portfolios of dividend stocks that can generate good passive income. Using the correct dividend strategy, you can really boost your portfolio. Dividend stocks can help reduce volatility and boost your total returns, helping you reach your financial goals a little faster. Using the tips provided in this video, you can aim at better investment planning for investing in dividend stocks. If you liked the information and found it interesting, press the like button. Also, tap to share this video with your investor friends, and don't forget to subscribe to our channel for more informative videos. We'll be back very soon.